Okay, so
Perfect.
guys, let's kick it off. I want to welcome my special guest today, Juan Montes from the Tax Problem. I decided to put this kind of Zoom meeting / webinar podcast together because there's a lot of stuff going on right now with taxes and the IRS and different things going on right now with COVID-19. Juan, you were a guest on my podcast, a few months back, and we talked about kind of your story and your business and how you got into it. So anybody who wants to find out a little bit more about Juan Montes, definitely go check out the episode that I did with Juan, and you can learn a little bit more about him and his background. But I really want to make this episode just more educational and kind of get into some nitty gritty. Us as real estate professionals, we get a lot of questions from our clients about taxes and also being an entrepreneur and self-employed. There's a lot of questions going on right now about, how these different things, are affecting us, the different, the extensions that happen, all the stuff that's been happening since COVID. So I want to cover some stuff that will apply towards, entrepreneurs that we can take advantage of and educate ourselves. So maybe some general topics that we get a lot, and then also some stuff more geared just towards specifically property owners, because a lot of our clients will probably watch this as well. And there may be some education that we can give them as far as being a property owner and what they need to know. So Juan, to kick it off really quick, the first thing I wanted to ask was, you are an enrolled agent, right?
Correct.
And I think we talked about that, in our last podcast, but give me like the 30-second, what's the difference between an enrolled agent, the tax preparer, the CPA? If I go to H&R Block and do my taxes, like, what's the difference? What do I need to know as a consumer?
Good question. So in California, there are 4 different individuals who can prepare a tax return for a fee. One is an attorney, second is an enrolled agent, a third is a CPA, and the fourth is what's called a registered tax preparer. And the big difference is the testing required, and then level of education can be a factor. But in reality, when it comes to taxes, the goal is you want to work with someone who has the experience and with what your needs are. And 2, ideally, you want to make sure that there's some, that they carry E&O insurance, errors and omissions insurance, and they protect your data, things like that. But for example, as an enrolled agent, you have to pass 3 exams, 3 4-hour exams that are administered by the U.S. Treasury, which is the overarching entity under which the IRS falls. And we have unlimited representation rights before the IRS and the state tax agencies. So if somebody has an issue, we get a power of attorney and we literally step into your shoes. They'll communicate through us. We get copies of all the mail you receive, and it's actually illegal for the IRS to reach out to you. Once there's a power of attorney on file, they'll deal directly with me. I'm your representative, and I'm the person advocating for you.
Got it. Okay. So there's a few differences in what you can do versus like a CPA or a tax preparer, right?
CPAs have these unlimited representation rights as well. And of course, attorneys do. Attorneys have their area of specialty as well. But in law school, for example, I graduated from law school and there wasn't a single tax class because it's not a requirement. And when you take the state bar exam, there is no tax law on the state bar exam either. So unless an attorney goes out and gets that experience in the workforce or takes additional training or education like an LLM or something like that, they won't necessarily have a tax background. The only individuals that are not allowed to represent taxpayers before the IRS at all levels are the registered preparers. They're considered what's called unenrolled preparers. And in California, the majority of preparers are actually CTEC preparers. Doesn't mean they're not good, doesn't mean they're not skilled. It's just that their registration is technically not a license and it doesn't give them the right to do that type of work. They could defend an audit on a return they prepared, for example, but they cannot defend an audit on a return they did not prepare. But for me, anybody who calls me, I can represent them as an enrolled agent.
Got it. Okay, that makes sense. Good stuff. So that gives me some clarity on kind of what you can do now. Like the H&R Blocks or like the local tax preparer down the street, that come out seasonal. Are those good? Are those good for some people? Who should go there? Who would come see you? You know, what's your opinion on that?
You know, I started out seasonal. It was a quote unquote side gig. So I definitely will never knock or disparage. You know, there's a client for everyone, depending on where you are in your career and what your focus wants to be. What I'll say though, is that, for example, yesterday I spoke to a gentleman. He owns a couple of rental properties. He's investing in stock. He's a day trader. He's got options from investing in early stage startups. So the guy's got a pretty complex tax situation, but he was going to H&R Block and there were all kinds of mistakes. And actually, you know, I already said the name, but I won't use any names going forward. The point is, he was going to a preparer that didn't have the level of experience he required. And he kind of just felt he wasn't getting the advice that he wanted. He didn't actually complain about anything. It was more like, I know I could be leveraging more and saving more, and that's what I'm looking for. So now we're working together. So really is know what you need and make sure whoever you're going to is going to provide that. The other thing is there are some preparers that you give them your documents, they'll prepare the return, they hand it back and they say, sign here. There's really no advice or communication or anything like that. It's not a bad business model, but that's not an advisor, and they normally will have a lower fee. For me, I'll ask you a bunch of questions once you give me your documents. We're going to review your return at the end. You're going to get a complete review, and I'm going to give you advice based on everything I saw and the questions I asked you. And I'm also available year round. This is all I do for a living. And all of my clients, I tell them, call me, because any questions you have, you're better off getting good info before a mistake happens, because in tax, oftentimes you cannot undo something once you've done it. And you want to make sure that my clients, every single day I get a call from someone, and all of that is included in my fee, but my fee is also not $60 like you'll find in some places.
Got it.
So higher fee because I offer an awful lot more as well.
So it sounds like to me, like maybe the simpler your tax situation is, then you can maybe seek out a lower level service. The more involved, or you have more stuff, or you need more strategic planning or advice and stuff like that, you're going to want to go with a higher level type of service.
Exactly. And the other thing is the consistency. You want your advisor to get to know you, because I can't tell you how many times I've saved people in the hundreds of thousands of dollars just because I knew something that we discussed maybe a couple years before. And when they, say they said something and I was like, but wait a minute, what about X, Y, and Z? And they're like, you're right. And we end up avoiding this costly mistake.
Got it.
So for example, to give you an idea, for example, what that mistake was not long ago, a client wanted to add their son to the title of their property. They're older. It was kind of their estate plan, let's call it that, because they didn't want something to happen to them, and then what happens to their house, and the house has like $1 million in equity. But I said, wait a minute, if you do that, they're going to give up all of the tax benefits they get when you actually, when something does happen to you down the road and they inherit, because it would no longer be considered an inheritance if they received the gift during your lifetime. And the reason that's important is, in their case, they purchased a home for $300,000. It's worth about $1.2 million. And if it's a gift during their lifetime, the child is going to get the cost basis that the parents had, which is what the parents paid. Whereas if the child inherits the property, when they take over, let's say the fair market value is $1.2 million, it's the equivalent as if the child had paid $1.2 million for that house. And the reason that's important is they could literally turn around and sell it the next day and pay $0 in income tax, because they sold it for 1.2. It cost them 1.2 the way the law works. And they actually have a loss after paying for real estate closing costs. And they actually would be able to write off a loss on their tax return. Or if it went up to 1.5 million, they'd be paying tax on 300,000. Whereas if they received it from their parents during their lifetime, parents paid 300,000. If they sell it for 1.5, they'd be paying tax on $1.2 million. So major differences, right? So instead, what I said is go see an attorney, drop a trust. That's going to take care of the problem you're trying to solve, and you're not going to make that mistake that's going to cost you, your child, hundreds of thousands of dollars in taxes.
Wow, that is huge, man. That's a huge, huge advice that you gave them, right? Because someone may not know. They may think they're doing the right thing to protect their asset. They add their kid on. Now their kid is taking it on at that lower tax basis and taking on a huge tax liability later down the line. So, man,
Yeah.
that's good. And a lot of people, if they're not educated, they don't know any better, right?
Yeah. Yeah.
Good
I'd say
stuff.
I came from a low information household. No one in my family knew any of this until I went out and figured it out because, my mom didn't graduate from high school. Actually, I'm the first in my family to graduate from high school, let alone college or graduate degrees. But, and that's why I like doing what I do. I get to help people make a difference in their financial lives.
That's awesome, man. That's awesome. Okay, so let's move forward a little bit. So I want to move on to kind of some questions that are geared more towards the entrepreneur, the self-employed individual. And I actually asked a couple of my teammates and a few people, and they sent me some questions. So there's a lot of people collecting unemployment right now during COVID, right? So whether you were a W-2 employee and you got laid off, or whether you're self-employed and you were able to qualify for some of the self-employed unemployment, how does that affect you tax-wise? Is that money taxable? What do they need to know about, collecting unemployment right now?
Good question. So unemployment insurance is taxable at the federal level with the IRS. It won't be taxable on your California tax return. So you want to make sure, it's tough to say, make sure they withhold money, because if, as it is, you're not bringing in enough to cover the bills, then it's a really difficult decision. But what you do need to know is it will be taxable. It will be included as income on your 2020 tax return. And in California, actually across the country, people are getting a $600 bump per week, which is an extra $2,400 per month on top of whatever else they qualified for. So the top limit being $1,050 a week, which is $4,200 a month. It's not a small amount of money that was going to end up being taxable, right? Now that extra 600 bump will run out at the end of July, but the other portion of the unemployment will probably stick around through the end of the year, through December 31st. So it could turn out to be a substantial amount of money, which will be taxable. If you can afford for them to withhold, have them withhold. If you can't, it's obviously going to be a difficult situation that there are a lot of unknowns still, but it will be taxable at the IRS level, not in California.
Got it. So you could make 30 grand this year from unemployment, and you're going to have to pay taxes on that 30 grand, right? Or it's going to be going to be calculated in your tax return. Okay, cool. Well, that's a good question.
And then the other thing, and the other thing to touch on, because it's important to know, a lot of people, I think now more people know, but initially, I know I was one of the people start putting information out there. Anybody who was looking for a job qualified for unemployment, even if you didn't have a job. And even if you hadn't worked in years, if you were actively looking, you qualified. If you had to stay home from work because you were taking care of a loved one or a high-risk individual, you qualified. If you yourself got COVID, you qualified for unemployment. If you were self-employed and your income decreased below the threshold, you qualified for unemployment. There was almost an exception for everybody, which means an awful lot of people qualified for unemployment. So those people who've been struggling and weren't aware, go on the EDD website and fill out a claim and see what you get, because a lot of people qualified for unemployment that did not traditionally qualify.
Yeah, and that's true. I'm seeing a lot of just in real estate, right? That they've never been able to get unemployment before for self-employed, and now they're getting it. And I think the issue we're seeing is some people don't want to go back to work because they're making more on unemployment than they would be making at their job, right? Because of the extra $600. Okay, cool. So let's move forward than that. Now let's talk about those SBA loans, right? There were the economic disaster loan. You can get up to 10,000. I know we got a few $1,000 for our company. We applied for it, and then we also got some payroll protection to help with the payroll expenses for a few months. We were able to qualify. So what happens with that? Am I going to have to report that as income? Is it the same as like the unemployment? Shed some light on that.
Good question. So no, first and foremost, it is not income, and it will not be reported as income on your tax return. The first loan you mentioned, the EIDL, Economic Impact Disaster Loan, is the first 10,000 are free money, 1,000 per employee. So let me give you an example. Let's say you, and I'm not sure how many employees you have, but let's say you had 7 employees. You would get $7,000 that off the bat you will not have to repay. That'd be free money to run your business, continue paying your employees, run operations essentially. And the rest, and let's say you ended up qualifying and borrowing an additional $50,000. What ends up happening is you won't make any payments for 12 months. And then after 12 months, you start making payments, and it's a 30-year loan. So you'll be making payments for the next 30 years, and the interest rate is 3.75, if I'm not mistaken. And but that initial sum that amounts to $1,000 per employee is a grant that is not taxable, and you do not need to repay. And the purpose of those loans were to help businesses, keep the doors open. And then the second loan, the PPP loan, it's the payroll protection program. The goal is they wanted people to keep employees on payroll, business to keep employees on payroll. It's been insane from the moment these loans were announced. The bill was signed on the 27th of March, if I'm not mistaken. Mm-hmm. And from then until through last Friday, there have been 26 updates on the rules to the PPP loan. So you have to read a ton of pages just to figure out what it is, and then do it another 25 times because there's been 26 iterations of this. So they keep changing things. The latest rules are this. You can, whatever you received in PPP, 60% of it needs to be used towards payroll. And PPP is different from the EIDL in that the PPP loan can be free money that you do not need to repay. It ends up being money that you use to keep your business open during this time. And as long as you use it according to the rules, you will not be repaying that money back to Uncle Sam. And so the rules are 60% of the funds of the PPP loan have to be used towards payroll. The definition of payroll is not just what you pay the employee. The definition of payroll actually includes some state and local taxes that you pay on behalf of the employee. It includes sick time you give the employee. It includes a few other perks that you give the employee. And all of that is rolled into the payroll calculation. The other 40% is supposed to be used for utilities and rent primarily. And if you're using the loan in that fashion, all of it can be forgivable. There are also some rules that you have to maintain the same level of headcount. So if you had if your PPP amount was based on 10 employees, and once it comes time for forgiveness, you have 10 employees, then you meet that criteria. But let's say you had 10 and now you have 9, you have 90% of the employees you had, so only 90% of the loan can be forgiven, right? So there's going to be all these other little rules that are going to apply. But then there's exceptions to that too. If to that one employee you offered them their job back and they declined because they wanted to stay home because they're getting more unemployment, as long as you document that, you won't get dinged for that person not coming back. The other thing that's a common question is, do they have to be the same 10 employees? No. People move away, things happen, right? People move on. And as long as the head count is the same, that's what matters. It doesn't have to be the same 10 employees as long as the number of full-time equivalents is the same. And then the other critical piece is originally you only had 8 weeks to spend this money from the day you received it. Now you have 24 weeks. So you have 3 times long. You have 6 months basically instead of only 2 months to spend the money, which is going to make it a lot easier to use up the funds in the ways that you're supposed to use them.
Got it. Wow. So it's actually a pretty good thing. I mean, it's helped us out a little bit. It wasn't a ton of money for us, but it's definitely helped us weather the storm. And it seems like based off what you're telling me, we should fall under all those requirements and hopefully not have to pay any of it back. So that's awesome.
Yeah. Yeah. And even the portion that does end up getting paid back, the terms are unheard of. It's a 1% interest rate and you have to repay it over a 5-year period. So it's
That's crazy.
That 5-year period starts after six months, I believe. So yeah, you have 5 years to repay at 1%, which is not even the cost of inflation. So it's essentially interest-free money.
Wow. Awesome. Now we can go on and on about that. There's a lot of details there, but I want to keep this kind of high level. And if someone has a question, they can always reach out to you directly and get some more information. Okay, so real quick, what are the updates on tax filing? Right, taxes are normally due March, April, depending if you're corporate or personal. When are taxes due now? Did they extend them again? What do I need to know? Can I file an extension? When do I got to do my taxes by?
Yeah. So tax returns are due by July 15th for federal and state of California. And the key to know is you can file an extension, and the extension would move it out to October 15th. They didn't move that deadline. But the key to know is if you file an extension, it's an extension to file, not an extension to pay. So if somebody knows they're going to owe, even if they file an extension, if they want to avoid failure to pay penalties, which can be pretty huge, they want to make sure that they pay by July 15th. They make that estimated payment for 2019 because the personal tax returns are due on the 15th of July. You can file an extension. The extension is only an extension to file, not an extension to pay.
Got it. Okay. And does that apply for personal and business?
It does. So that deadline applies to everyone who had a 4/15 deadline. Partnerships and S corporations have a deadline of March 15th, which was before these extensions were granted. I don't know off the top of my head if those two also were extended automatically to July 15th. But at the end of the day, those individuals should have filed an extension before the 15th of March anyway, because or else it would have been late to begin with, right? But when the IRS made the announcement that the new deadline would be July 15th, that announcement was already after the 15th of March, which would have made those returns late already. But a regular corporation and a regular individual or sole proprietor, those are our 7/15 filings with an extension available to October 15th.
Now, do you think they'll extend it again because of, we're still not out of the woods, so to say?
There are rumblings that they want to push it out to September 15th. So I guess there's a possibility, but the info what we have today is the due date is the 15th of July. But if there's an update, I'll shoot you the details so that you could give it out to the masses and your fans.
Because I have a feeling with a lot of businesses that are trying to weather the storm, they probably got money put away for taxes, but they're probably not getting any income in. So they may be dipping into the money that they were going to pay the IRS for their 2019 taxes. Right? Do you think that's true?
And I think, that's absolutely happening across the country. And then the other reality too is business owners are struggling and thinking about ways to keep their business afloat, not necessarily thinking of I need to get my tax return prepared, right? Which was the whole reason they extended the deadline to begin with, is they knew people had other priorities at that time. You can't leave your house, you shouldn't be around other people. And so the reasons that existed for extending it to begin with are still there. And now even, more prevalent, because now you could actually put numbers before, whereas before you expected it to be bad. Now it was bad.
Wow. Wouldn't it be nice if the IRS just said, hey, look, this year, because of all this, we're going to slash your taxes 50%. Whatever you owe us, just give us half and we're cool. We're good to go. I mean, they should do something like that, because a lot of the people who pay the most taxes are the business owners, right?
Mm-hmm. Yeah, absolutely. Yeah, that'd be real nice.
All right, so see if you can talk to someone, bro, over there at the IRS.
I'll send my Theo a message, see if he'll listen.
You can pull some strings or do something, right? All right. Okay, so is there anything else that you think we should cover? Anything that you think is important right now as far as entrepreneurs are concerned, self-employed individuals, anything they need to know with updates with COVID before we move forward?
Yeah, let me look at these questions that your team had sent us. One thing that we didn't mention talking about those PPP loans is we've got a situation for rental property owners. So people who own rental properties qualify for the EIDL loans. and they also qualify for the PPP loans. So proprietors, we know that they qualified. People who own partnerships, things like that, they all qualify. It's just the calculations will be different based on your circumstances. And we don't need to get into those details because they're fairly complex. But if somebody has a rental property and they have this rental income, they are able to qualify for both the PPP loan to protect those profits, or EIDL loan, especially if their tenants aren't paying rent, to make sure they're able to pay their mortgage during this time. The other thing, which is not entirely tax related, but has been huge during this time, is the whole mortgage forbearance with the government. Part of the CARES Act from March 27th was they told the federally backed mortgages, or lenders who have federally backed mortgages, that people would qualify for an automatic 6-month forbearance. And if at the end of the 6-month period they still couldn't afford to pay their mortgage, they could qualify for another 180 days, which puts it at 360 days, which is basically an entire year of not paying your mortgage. But a few big concerns came up as lenders were telling people, when they were giving people 3 months instead of 6, or they were telling people when your 3 months are up or your 6 months are up, you're going to have to make a big lump sum payment of the entire amount. So if they can't pay as they go, they're certainly not going to be able to pay it all at once when that period ended, right? And the CARES Act didn't make that clear. They didn't talk about what would happen with the missed payments. They later came out and issued guidance to the lenders, basically saying you need to work with the taxpayers, and ideally what you need to do is just tack it on to the end of the mortgage. So that's one thing. The other thing that's huge is generally when someone's not current on their mortgage, they wouldn't qualify for a refinance, they wouldn't qualify for a new mortgage. There'd be all these other problems that come along with getting into forbearance. Some guidelines were released recently where they're saying that if once people get back on their feet and they can afford to make their payment, as long as they make 3 payments, they'll be able to then refinance or get a new mortgage on a new home. And the fact that they didn't make payments for 6 months or 12 months or whatever that period was will not be held against them. And that will not be hitting their their credit report either as a late payment.
Wow, that is huge. Because when it first came out, I actually looked into a forbearance on my property, and they told me I was going to have to owe everything after 3 months. So I'm like, I might as well just pay it. If I'm struggling, I might as well cut some other stuff out or see what I could do to minimize my expenses. But if I couldn't, if I was having an issue now, how am I going to pay the whole 3 months, in one pop, right? So that is huge, So I just left it alone. I didn't take the forbearance, but I might have to revisit that and see if it makes sense, because there's a big transition of us trying to get back into the office and get back on our feet. And I'm sure a lot of people are going through the same struggles right now.
Yeah, and the thing is, what they needed to avoid was a wave of foreclosures, right? Because if they expect you to make these 4 payments or 7 or 12 or whatever the number is all at once, people aren't going to be able to do that, and that initiates the foreclosure process. And then we have a repeat of 2008 where there's 10 foreclosed properties on every street, and prices tank and everything else. So 2008 is what drew this lesson to tell them. And then the other thing is, just yesterday, Powell, the head of the Federal Reserve, came out and their forecast is we're not going to really be out of the woods on this until like 2022, at least economically. They expect all of this year high unemployment, all of next year it'll be a little better, but still high unemployment, and we won't really start seeing smaller numbers of unemployment until like 2022.
Wow.
And all of that factors into the situation about making mortgage payments and everything else.
Wow. Good information, man. Okay, so I want to wrap up the end of this segment with just talking about some general questions that we usually get from property owners. When we're helping people buy homes, sell homes, especially, there's always questions surrounded about what are my tax liabilities when I sell my home. A lot of people that are selling their homes and moving out of the area and stuff, they bought their homes a long time ago. So I just want to talk quickly, maybe just give us a quick overview of how do we calculate taxes, maybe some of the basics when I'm selling my primary residence. If I bought my home for $100,000 and now it's worth $1 million and I want to sell it today, what am I looking at and how do I figure out kind of rough numbers?
Okay. So great one, because just this week I have a client with the exact issue. She went to a prepare, wasn't like we were talking in the beginning of the segment, that prepare wasn't quite up to speed on the rules and told her she had a $58,000 tax bill. So what happened is she bought this home in 2005 for $500,000. She sold it last year for $810,000. So there's a $310,000 gain, you know, apparently a $310,000 gain. But what happens is when someone lives in a property and it's their primary residence and they live there for 2 out of the 5 years from the date of sale looking backwards, they qualify for an exemption where they will not pay taxes on up to a $250,000 gain or profit. So in her case, you know, just using rough numbers, 810 minus 500, that's a $310,000 profit, right? It was her primary residence. She lived there since 2005. So off the bat, $250,000 will not be taxable. So now that leaves us with $60,000 to deal with. Well, the other thing you can reduce are the cost of sale. So real estate commissions paid, cost of escrow, you know, all of these miscellaneous costs that you incur when you're selling it end up being an expense that will offset that gain. So you're able to, you won't pay tax on that either. Then the other component to this that is pretty huge, and people, anyone who owns a property, you know, if you're replacing the driveway, you're replacing the roof, you're remodeling the kitchen, or actually you, I think you did a massive remodel on your house recently. Save those receipts and take pictures of everything. Because even if you don't have some receipts, as long as you can prove you did the work, you'll get some kind of tax benefit. It's just not going to be maybe what you spent, right? And there's case law that backs this up. But at the end of the day, whatever you've spent in improvements on this property adds to the basis also. So in her case, we didn't need to dig into improvements too much because between closing costs and the $250,000 exclusion, her tax return's actually getting her about a $5,000 refund between federal and state, where the prepare where she'd gone told her she was going to pay $58,000. So if she didn't double check that, if she didn't reach out to someone, she would have been forking over a check for $58,000 on money she didn't even owe. So that's, you know, loosely how it gets calculated. What you paid for the property, what you've spent on improvements on the property, you subtract that from the sales price, and then you also can subtract your closing costs, and then you end up with what the taxable gain is. Notice nowhere in there I said how much you owe on the property, because what you owe on the mortgage has no bearing whatsoever on the way capital gains are calculated.
And see that's first of all, man, that's awesome that you were able to educate her. Because imagine you go to your tax preparer and they're like, you owe $60,000, and even one of our clients I think had that issue. We referred her over to you, and you were able to talk to her about it. But if you tell me I owe 60 grand, I'm like, what the? Where do I get this money from? And then they talk to you and they're like, you owe 0, or you're getting 5,000 back. That's a huge discrepancy, man. You know, so I'm sure you made her day, you made her year.
Yeah, and you're being told in the middle of COVID you owe $58,000, right?
Wow.
Crazy when you're not
crazy.
working. Oh, it's crazy.
And then the other thing too is that what you said at the end, notice how you didn't say what they owe on the property. That's actually a big misconception that we get from a lot of clients. Like, hey, I'm selling my house for $1 million. I owe 800,000. You know, that's 200. I get to keep all this. They think it's what you owe, but it's like, they're not talking about the refi they did and they pulled out 300 grand equity line or whatever, right? So never in there it's what you owe. That's correct, right?
Yep. Yeah.
So,
yeah, what you owe is 100% irrelevant to the calculation.
So what you bought it for, minus what you're selling it for, minus all your deductions, and then you said it was 250. They get to reduce, and if you're married, is it more, right?
It's 500,000, so 250 for individual. And you know, sometimes brothers and sisters or friends own a property together. Let's say 4 of us owned a property together. Well, each of us would have a 250,000 exclusion. So that property could have $1 million in gains, and no one would pay taxes on that gain.
Wow.
So, yeah, wow. 250,000 per person. If it's a primary residence and you live there 2 out of the last 5 years, looking backward from the date of sale.
Wow. Okay.
And that only applies to your primary residence, not rental properties or second homes or anything like that.
Got it. Got it. Now, let's say after all those deductions, you know, because I bought my house a long time ago for, you know, really cheap, and I sold it for a lot. I still have some taxable gain left over. Let's say at the end of everything, there's still $100,000 that I owe taxes on. Now, how do they figure out how much I'm going to pay on that 100,000 that's left over?
Good question. So that calculation is pretty complex. So I can't give you an exact number, but basically long-term capital gain rates are anywhere from 10 to 20%. So actually 0 to 20%, because somebody like a married couple that has 2 children, they could pay 0 capital gains on up to right around $75,000, $70,000 to $75,000. So if the profit was under 70,000 bucks, possibly there's no tax at all. But if the gain is 200,000 on top of that, so what determines whether you pay 10, 15, or 20% in that range is your overall income, how much you have. And the higher you have, the higher you end up paying on the capital gains. And then California, this one is pretty bad for California. California doesn't have a long-term capital gains rate. So on the California side, the gain of sale of a property that ends up being taxable is treated no different than your wages at your job or from your business. So it could be taxed up to 13.3%.
Wow.
The other thing that can happen on the federal side is there's something called the net investment income tax, which is just over 2%. And the thresholds are pretty high, but if you're up in the $300,000 to $400,000 in income range, all in, you end up paying an additional 2% tax, just over 2% tax, because of the net investment income tax as well. So that's another kicker to be aware of.
So I know there's variables, but what I'm hearing is you're going to have to pay some state tax on that money, right? You say California was 13%, and then you're going to have to pay anywhere from 0 to 20% from federal. And then if you have a higher threshold, let's say you make a lot of money from your actual income, you can have another 2% on top of that, right? So there's a big swing right there, right? So I think it really boils down to how much money do you make outside of this property, right? What your income is, and then what that actual number is that you're left over for taxes, right? You put those all together, and then you could figure out your tax rate, right?
Exactly. It's a puzzle. All those different pieces, we have to put them together to arrive at those numbers.
Got it. And I think the big thing is when I meet with clients that want to sell their home, and especially if I know they've lived there for a long time, the first thing I say is, hey, are you aware of your tax liability on this home? And I cannot tell you how many times where our clients go, huh? What do you mean? I thought, like, as long as I'm going to buy another home and put it in there within 2 years, I can, I don't have to pay any taxes. So I think that was how it used to be, right? You can transfer your gain or something. Was that true at all?
You know, that might have been before my time, but in my 15 years, that's never been the rule. The only area where you're able to sell one property and buy another and not pay taxes are investment properties for the 1031 exchanges. So the way those exchanges work is the property you're selling has to be an investment property. And what happens is when you put it on the market, you have to make sure you hire what's called a qualified intermediary. And what happens is when the property actually sells, escrow will not cut you a check. They'll send the money to the qualified intermediary. And they'll charge you a fee. I think it's right around $700 or so. But they have to hold the money. If at any point in time you touch that money, you cannot do a tax deferred exchange. So you have to hire a qualified intermediary. From the day you sell the property, you have 45 days to identify the replacement property. You can identify usually 3 properties, and then you have 180 days from the date of sale where you have to close on one of those 3 properties you identified within those first 45 days. So the 180 doesn't start after the 45, it starts from the date of sale. The 45 days also start from the date of sale. And then the other key thing is a property you end up buying also has to be an investment property. It cannot be a home that you buy and then just move into it. If you do that, it doesn't qualify for the tax deferred exchange. A common question is, well, what if I don't move into it right away? there's a safe harbor rule that says that if in the first 12 months after you acquire that investment property, it's rented for more than 14 days, and you don't live in it, then you could convert it to personal use after that. So I guess think of roughly a year timeline. If after that year you end up moving into that property for some reason, then you still end up, with this tax deferred exchange, which, like you said, here in the Valley, there are a lot of people who purchased their home many years ago under 100,000, and they might be worth $1, $2, $3 million. I had a client recently purchase a home for under 100,000 in Menlo Park, and it was worth over $3 million. And for them, they inherited the property, so they got that step up in basis we talked about earlier. So in the hands of the child, it's as if the child paid $3 million for that house. So when they sell it, they're not going to pay any taxes on that money, on $3 million in income, even though their parents only paid $100,000 for that house.
Wow. So I think the big thing, guys, is I know this stuff can get a little complicated, and to kind of keep it simple is when you're going to sell your primary residence, you definitely want to consult with your tax advisor and see how much you're going to owe on taxes. Because if you think you're just getting all that profit and you're going to use that to buy your next home, you got to factor in what you're going to owe the IRS. And then with rental properties, we help a lot of clients do 1031 exchanges. We work with a good intermediary that you're talking about. There's strategic planning that you can do to sell one rental property, buy another rental property, and not have to pay any taxes. And then later down the line, if you want to move into that property after you've rented it out for a year or so, you can eventually convert it to maybe a primary residence, right?
Mm-hmm.
So there's a lot of things.
The intent to have it, yeah.
Awesome. Okay, so that was actually some of the next questions I was going to ask. So we kind of naturally covered those. Now the last one is to kind of wrap it up. How much mortgage interest can we write off now? I know there was some changes with the tax law. Before you can write off all your mortgage interest, and now they've changed it, at least I think in California. So what can you tell us about that?
Good question. So the old rules were $1 million and $100,000 on an equity line. The new rule per taxpayer, and under the law, an individual who's single is a taxpayer. But if somebody is married, then the family unit is a taxpayer. So husband and wife, although they are two people, they would only be able to write off interest on $1.1 million between mortgage and equity line. Those are the old rules. The new rules are you're limited to writing off the mortgage interest on $750,000. So if someone is dating boyfriend, girlfriend, and they buy a $1.5 million house, and let's say the mortgage is $1.5 million, they can write off the interest on the entire $1.5 million. But the moment they get married, they will not be able to write off half of the interest. It will drop to $750,000. So it's $750,000 per family unit or per taxpayer.
So that means whatever the interest is on that 750,000 is what they can write off, right? So if it's 20 grand of interest at the end of the year, they get to write that portion of it off.
Yep, that's correct.
Got it. Okay, Juan, any last final thoughts? Anything else you want to tell anybody else out there? Anybody who's maybe a business owner, entrepreneur, property owner, any last key piece of advice when looking at tax situations right now, or just their taxes in general?
Yeah, I would say, always reach out to your tax advisor, whoever that may be, when you have a question, because these high dollar things, little mistakes can cost thousands and thousands and thousands of dollars. Always call and reach out. The advisor you're working with doesn't have the capacity to handle what you need. Look for a new advisor, even if it's only for that 1 year or whatever it is. But when you have a need for a specific expertise, make sure you look for it. If you're TurboTaxing it, same thing. Make sure you look for it, because there are a lot of rabbit holes, a lot of nuances to this, that if you try to Google your way through it, it's highly unlikely you're going to get the full picture. So you really will save a lot of money by reaching out, and a lot of people probably could give you a free 30-minute consult. Like for me, I know, like with you, anybody you refer to me gets a free 30-minute consult. And a lot of times people's questions are answered in those 30 minutes. And sometimes from there, they actually need me to do some work, and then we discuss fees. But that initial 30-minute consult is at no charge to just, help people out, because if we can figure it out in 30 minutes, I'm okay with giving that away.
Awesome, man. I really appreciate that. We've referred a couple clients over to you. Guys, anybody who needs help, reach out to Juan. I'll put his contact info, in the description and stuff. Real quick, Juan, what's your website and what's your phone number?
Website is www.thetaxproblem.com, and my phone number is 408-888-5139.
There you go, guys. I'll also drop that in the description. But Juan has a wealth of knowledge, guys. Like, pick his brain, use up the free 30-minute consultation. I'm sure he'll definitely leave you better off and answer some of your questions. And then your big specialty is you fight tax debt, right?
Yep. I help people fight the IRS every day, defend audits. Just this week, we reached a settlement. A client owed $60,000. They're paying $500. So, and they'll be tax debt free. So, we fight the IRS all day long, defend audits, appeals, any tax problem, we figure it out.
So there you go, guys.
Doesn't guarantee the perfect result, but obviously, if we have something to work with, we'll do something with it. Absolutely.
Yeah, and everyone's situation is unique, but if you have back taxes that you owe, you're in a tax situation, you owe the IRS, Juan is definitely reputable. I always do my homework before I bring anybody on here and recommend them to my clients, and he's definitely someone that we can trust. So, Juan, I appreciate your time, bro. I appreciate you coming on here. Hope you're staying safe and healthy during COVID, and I'm sure we'll be seeing each other soon with some clients that we can help.
Absolutely. Thank you very much for having me. Stay safe.
All right. We'll talk soon.